Hi there, everybody. In this lecture, I am going to discuss how to prepare financial statements. We're going to work through a problem. We're given the account balances for a startup company. We're going to look at the company after their first month of operations. And we're going to look at the balance of each of these accounts and use that information to prepare three of our financial statements. So, the company that we're interested in is McKinley Charter Services. And this company runs charter boats out into the ocean for deep sea fishing. So we can see some of the different expenses and revenue types and also the assets and liabilities that we have for this particular company down below. So let's go through each one of these really quickly so we get an idea of what we're dealing with. And then we'll use this information to actually prepare our financial statements. So we see here the balance in our equipment account is $17,000. So Guy McKinley, the owner of this company, might have a bunch of different types of equipment, maybe fishing rods and reels, life preservers, things of that nature that he's going to keep on his boat. So if we add up the value of all that different equipment, it comes to $17,000. Our accounts receivable is $2,600. Remember, accounts receivable is basically IOUs that we're in possession of. It's money that's due to us from our customers. So maybe Guy performed a bunch of services throughout the month, and customers didn't necessarily pay him in cash, but they're going to pay him later. Well, this is the balance at the end of the month of all the money that's due to Guy from his customers. Fees income is just totally the amount of fees that the company earns for this particular month. So this month in August, Guy earned $28,000. We see a category for boats. That's just the value of the boats. Maybe he has several boats that he uses for his charter company. All right, the total value is $103,000. Over the course of the month, he ran up $6,500 in gasoline expense. We can see some other expenses here as well. Rent expense. Maybe he rents a building where his customers come and actually get on the charter boats. He had a salary expense of $9,600. That's money that he paid to his employees, utility expense, maybe for electricity bill, things of that nature. All right, so those are our expenses. Loans payable. Maybe Guy took out a loan to start the business. He owes $77,500 on that loan. Owner's withdrawal. What this means is that at some point, Guy took money out of the business. All right, owner's withdrawal means you're withdrawing money from the company. So he had $5,000 in cash on hand at the end of the month. He had $2,300 in supplies on hand at the end of the month. And Guy's initial investment in his business was $51,000. So he contributed $51,000 maybe in cash from his own personal bank account to be used in McKinley Charter Services. So the first thing we're going to do is create our income statement. And remember, there's a very structured way that we go about preparing our financial statements. You have to do the income statement first, or you won't be able to do the other ones because information that we get from the income statement carries forward to those other financial statements. So, what we're going to do is use information from these accounts to actually prepare this financial statement. And notice the first thing you're going to do when you prepare an income statement is list the name of the company. Then on the second line, you'll put income statement. And then you'll put the end of the period. We're dealing with the month of August here, and we're looking in the future, hypothetically, at 2016. So we're looking at month ended August 31st, 2016. And notice this is an important concept when we're dealing with the income statement. This income statement covers the whole month, all right, the month ended, or it can cover a whole year or a whole quarter. The idea is it covers a period of time. It's not just one point in time. It's looking at the income created in a period of time. So this is how much income we had for the month of August. And if you guys remember, profit is just revenues minus our expenses. And that's basically what we're going to do with our income statement. We're going to look at all of our revenues, we're going to look at all of our expenses, and we're going to net them out against each other. We're going to subtract those expenses from our revenues. So what we want to do to prepare this income statement is go back and look at these individual accounts. We want to really specify accounts that have to do with revenue coming into our company and expenses going out. So first thing, we put revenue up here whenever we do our income statement, and we're going to look at the specific type of revenue coming into this company. Well, if we go through all these accounts, there's really only one that is attributable to revenue, that fees income. All right, that's money that was paid by customers, all right, for using his charter services. Well, he earned $28,000 through the month of August. So we have that over here. Notice that's over in the right-hand column, $28,000. Now that's his only revenue for the month. So we want to match our expenses against that revenue to figure out what his profit, or we also call that net income, was for the month of August. So notice his gasoline expense was $6,500, and we're just pulling those numbers from the individual accounts. And it's pretty easy to identify expenses with Guy's business because it's explicitly listed. Gasoline expense, $6,500. Notice that was the first one we had listed there. Second, rent expense, $4,500. Put that below. Salaries expense, $9,600. And then our utilities expense, $1,900. All right, you can see that we get our utilities expense from right up there. And it looks like Guy did this in alphabetical order, right? Gasoline, G, then R, then S, then U. Now, we see here, we have this underline, this $22,500. That's the total of all of our expenses. So if we add up all those expenses, bring them over here, that's going to be our total. Notice what happens. We're trying to calculate net income. This is the whole idea behind the income statement. We're trying to figure out what was our net income, what was our profit for the period. And of course, that information is really important for a number of different users of these financial statements. The owner of the business wants to know what his net income is because he wants to know, am I doing a good job? Am I doing things right? Investors might want to know about net income for a company because they want to kind of figure, is this worthwhile to actually invest in this particular company? If they're not making a lot of money, if they don't have a high net income, maybe they might kind of decide against investing in it. Also, creditors, potential creditors, maybe this company's looking to get another bank loan. Well, the bank would be interested in the net income. They want to know, do they actually have enough net income or prospective net income that they're going to be able to pay back this loan or pay the interest on this loan in the future? So this $5,500, all we're doing, again, just taking our income, or rather our revenue, the $28,000, subtracting out all of our expenses, $22,500 is the total number of our expenses, and the difference between those two is $5,500. So that was the profit for the company for this month. So that takes care of the income statement. Next statement we want to look at is the statement of owner's equity. All right, and notice again, we start this one by putting the company's name down. Then we write down the name of the financial statement, statement of owner's equity. And again, we're looking at a period of time. Month ended August 31st, 2016. So not only are we going to use information from up here within our accounts, but we're also going to use information from the income statement to calculate this statement of owner's equity. Notice this $5,500, we're actually going to bring it down. So we're taking information from two different places now. And remember, I said we had to do that income statement first. If we didn't have this $5,500, well, we couldn't complete this statement. So we have to go through that order. Do the income statement first, then the statement of owner's equity, and we'll see we do the balance sheet very last. So this very first column is going to be what our starting capital was at the beginning of the period. So on August 1st, as the very first day of operations for this business, Guy contributed $51,000 to the company. All right, so that was the initial capital, $51,000. Now notice he earned $5,500 for the month of August. That's what we calculated earlier. We just brought that number down here. Remember at the very beginning of this lecture, I talked about this column here, owner's withdrawal. Guy took $4,100 out of the business. All right, so he took $4,100 out. Maybe that's how he paid himself. So we see here, we need to subtract that out. $5,500 net income, that was extra equity in the business, but we have $4,100 less because Guy took some out. So we had some additional equity, but we also had a subtraction from equity. So what we want to do to arrive at this $1,400, and we're looking at the increase in our capital. All right, well, that's the difference between these two figures. We take the $5,500, subtract out 4,100. This 1,400 is the difference between those two. Now, what we want to do to figure out what our total equity, our total capital for Guy in the business is, we take our beginning equity figure and then look at the change. So we had $51,000 in beginning equity. Well, we made $5,500 in revenue, so equity goes up because of that. Remember, revenue is a subcomponent of equity. When revenue goes up, our total equity in the business goes up, but money was taken out of the business. There was withdrawal, so that made it go down by 4,100. Well, in total, it went up a little bit, right? It went up 1,400, so we take the beginning amount, 51,000, add your 1,400 to it. Our ending equity on August 31st, 2016 was 52,400. Just that 51,000, subtracting out that 1,400. The 1,400 was the change in capital. Notice we had increase in capital for this month because the capital went up. It doesn't always have to be that case. If Guy would have taken out 10,000 in owner's withdrawal instead of 4,100, we'd actually have a decrease in capital. We'd have a negative number here, and we would subtract that from our initial investment. But that wasn't the case here. Our capital actually went up for the month of August. So that was our second financial statement we completed. Now, once that's done, we could actually go down and complete our balance sheet. And keep this $52,400 in mind, because that's what our change, after our change, I should say, that's how much equity we had in the business. All right, so I reproduced over here the accounts that we looked at initially, and we're going to use these to complete the balance sheet. And keep in mind, there's two different types of accounts in general, what we call income statement accounts and balance sheet accounts. So those expenses and revenues, those things we included earlier on the income statement, we categorize those as income statement accounts, just in general. So things that we put on the balance sheet, we call those balance sheet accounts. So notice anything that's an asset, liability, or equity is going to be included in the balance sheet. The balance sheet, remember, is just looking at one point in time. When we looked at the other two statements, we were looking at a period of time, the month of August. Notice when we list out the balance sheet again, with the name of the company, the name of the particular financial statement we're producing, but we don't have for the month of August, we just have one particular date, August 31st, 2016. So the balance sheet is showing us a snapshot at one particular point in time of all the company's assets, liabilities, and equity. So notice over here on the left-hand side of the balance sheet here, we have our assets listed. Over on the right-hand side, we have the liabilities and owner's equity. We call this the accounts form of the balance sheet. We'll see in the future there's different layouts or different formats for the balance sheet. You can actually see it where you have the assets listed here, then the liabilities underneath, and the equities underneath that. But for today, we're going to go with this format when we produce our financial statement. So what we want to do first off is list all of our assets. So we go back to those ending balances for our accounts, and we just pull all the assets down. And we order the assets in terms of liquidity. Remember, liquidity is just how easy it is to convert something into cash. All right, well, cash is cash itself, so it's the most liquid item, so we list that first. So we go back, look at our different accounts, pull out the number from cash, 5,000, bring it down here. Accounts receivable is considered to be pretty liquid. That's money that's owed to us by our customers. We expect that's going to be paid to us back fairly rapidly, so it's a pretty liquid item, so we list it second in our order here, and that's 2,600. Our supplies are going to be third, 2,300. Keep in mind, these are all assets. This is property owned by the company that we have some measure of control over. All right, equipment, 17,000. And again, just pulling those numbers, all right, from our ending balances. And those boats, that's the least liquid thing, right? It might be harder to turn boats into cash than it is to turn accounts receivable into cash. It might take us several days, weeks, or months to sell our boats if we want to turn that asset into cash. So that's the least liquid asset, so we list that last. And notice if we add up all the values of our different assets, it comes to 129,900. That's our total assets. So we calculated what the assets were in the balance sheet. Now we got to figure out what our liabilities and owner's equity are. And remember that we had that accounting equation that we looked at earlier. Our assets should equal the sum of our liabilities and owner's equity. If those two things aren't in balance, then we have a problem. So we really only have one liability. Remember, a liability is just what we owe as a company. Well, we took out a loan for $77,500. We still owe that amount. All right, so that's a liability. That's the only one we have under that category. Notice next thing is our owner's equity. Well, the capital, $52,400. Remember, I told you to keep that in mind. We have that right up here. That's what we calculated from the statement of owner's equity. So that's really important. We can't produce the balance sheet unless we produce that statement of owner's equity. We can't do that statement unless we do the income statement, because we needed to get that. To get that, then the $52,400 we need to calculate to be able to bring it down here. So last thing we want to do is add up our liabilities, our loans payable in this case, plus our equity, the $52,400. We add those up together, we get $129,900. Notice the sum total of my liabilities and owner's equity equals the total of my assets. They're both $129,900. So that's a good thing. We know we're in balance. That's a very, very good sign. So that's just a brief review for one particular company of how they calculate or how they produce those financial statements. Hopefully that'll be useful for you guys as you move throughout the course and prepare financial statements. Every company is different. They're going to have different accounts, but generally they're going to follow the same process of producing the financial statements in this order.